So first, I just wanted to thank you guys for inviting me to PLOTCON because, number one, I got to come make a trip back to the Bay Area, which I always love to do. And number two, I think it's really increased my nerd cred with the developers at Quantopian, who are all surprised you invited me since I'm not really a software developer. So just a quick background about me and Quantopian that I think motivates the library I'm going to talk about today. Quantopian's a platform where anyone with access to the internet can write algorithmic trading strategies. My research team selects the best trading strategies and allocates capital to them in the actual stock market with actual money, and we pay the authors royalties based on how well their algorithms do in the market. So this is sort of the use case that motivates a lot of the research and development work that we think about at Quantopian. And today I'm going to talk about visualizing factors that make stock market predictions with this library called Alphalens that we've developed and have made available open source. And I will say that I really enjoyed the last presentation, and I had to immediately go check how many stars we had, and I hoped that it would be more than 10. I think it's like 200, so that seems good. So now I'll have to check all of our other libraries or repositories. So what I'm going to try to do, I know this is FinTech Day, but I tried to sort of assume very little about the actual finance background. So I'm going to give a quick lightning tour about quantitative factor investing. Then I'm going to talk to you about this visualization package that we built, and I'm going to use some real world examples. All right, so, and I guess I should say also, I'll give a link at the very end of this talk. I took this mostly from a lecture that was created on our educational portal that's available. It's like a Jupyter notebook, and so you can get after the fact at all of this code, and actually even like the specific example I'm showing, you'll be able to get at that. All right, so a couple of finance-specific terms, or even specific to quant finance, and actually very specific just to even how I'm going to use them in this talk, but I thought it would be helpful to define them because people in the quant finance industry tend to throw around a lot of jargon that's not necessarily always defined, and actually even within the field can mean different things to different people. So I'm going to use all of these words, and I wanted to just explain what each of them means. And I'm not trying to talk down to you. Just even within our field, there are different ways of thinking about these things. So when I talk about returns, I'm talking about a time series of data that's observed or simulated, which is profits and losses incurred by an asset or an investment strategy. So for example, if I have a portfolio and today it went up 1% and tomorrow it went down 1%, first of all, that would be crazy, scary. That's a big move, but that's the type of time series data that I'm talking about. Second term is a quantile. So that's like a simple term, I think, that's used across a lot of fields. Basically a set of values that divides a frequency distribution up into equal sized chunks. So the key being each quantile, right, if it's 4, you call it a quartile. If it's 5, you call it a quintile. I'm going to talk about quintiles today, but you can choose any sort of set of quantiles you want to divide up a distribution. The next one is factor. So that can mean a lot of different things in a lot of different fields. In quant, it means a time series of values that may hopefully explain future stock returns. So that's the kind of predicting the future part that I'll talk about, which turns out to be extremely challenging to do. Beta, we specifically use to mean exposure to general market returns. So what do I mean by exposure? Literally one way you do, and what I'll talk about, is you just compute a trailing rolling regression, linear regression of the time series you care about, let's say your portfolio's returns, with the returns to the market. So you can imagine I'm going to maybe use an ETF that holds the SPY, or that holds S&P 500 stocks called SPY. So if I literally just also own that asset in my portfolio, those two things should correlate 100% with each other. So if the market goes up 1%, like measured by this ETF's returns, and I own that ETF, correlation of 1 would be a beta of 1. So alpha, much more elusive. You'll hear this thrown around a lot, heavily overused and loaded term. Specifically, people use alpha as shorthand to mean returns you generate in a portfolio that are not explained by common risk factors. The reason alpha is often very difficult for people to agree on is it's like what's left over after you take away a bunch of explanatory variables, and everyone chooses different sets of explanatory variables to take out. And some people think there's no such thing as alpha, that alpha is just simply like noise or residuals or what's left when you don't understand all the risk factors you're exposed to. For the purposes of this talk, I'm going to assume that alpha is actually a real thing that exists and we can find. And lastly, sector. The whole stock market in the US is broken up into sectors, so things like tech, healthcare, utilities, financials. There are companies that provide classifications that tell you what sector is a given stock in, and so we can use that as another way to divide our data and look into it. All right, so feel free to stop me if I'm using jargon and it doesn't make sense. So the whole point of this library is to look at factors, right? So we need a factor as an example. So I picked price momentum. Price momentum is thought to be motivated or thought to be driven by a behavioral bias of sort of herding, hence my subtle graphic. So we're going to look here at a really simple implementation of price momentum. Just ask about every single stock today. What was your price 12 months ago? And what is it today? And if it's higher, I'm going to call that good because I think that everybody is buying up your stock and its price has gone up for a whole year, or at least it's up higher than a year ago, and maybe on a relative basis, right? So I'm going to rank my whole universe on price momentum. This is the very simple. We're pulling in pricing data on the Quantopian platform, but you can use Yahoo Finance prices if you're using our backtesting environment or any of these libraries locally. Great, so price 252 days ago. The market doesn't trade on the weekends for non-professionals, and so 252 days is about how many trading days there are in a year. So we think in increments of 252 a lot. All right, so let's say I want to actually use Alphalens. Now I've built this factor, and I can plug it in and feed it through this Alphalens library to say whether it predicts the future or not, and at what time scale. So here's how that would work. We have an API to grab pricing data that's called pipeline, which you can look into, but basically this line of pulling my pipeline, that's just going to say I want to grab a year of stock market data for the US stock market. So I'm going to look at everything January 1st, 2015 to January 1st, 2016. And here you can see what this factor is. On a given day, here are the first 4 stocks that show up. So one of them's Apple, great, I recognize it. And we have some factor value, right? It's the ratio of its price today to 12 months ago. Great. So this is a Panda series. Every factor, there's a factor value for every equity in the universe at every point in time. So that's sort of the picture of the data object that we're going to be working with. All right, so back to the idea of quantiles. It turns out a very useful thing to do with extremely noisy data sets like financial market data and factor data is to basically take them from just a distribution and then quantize them, right? You could do something really simple like even binarize data. A lot of times people do that to do a study. Here we're going to do a quantiling. So just like I told you, we're going to take all our factor values. So imagine I cared about, 500 stocks today. I'm going to look at the distribution today, and I'm going to bucket them and say, okay, are you in the 1 to 100 bucket? You're a 1. So I'm throwing away the information about whether you were a 1, 2, 3, 4, 5, 6, and you're just a 1. And I'm going to do that and quantize. So I'm transforming these continuous values into this quantize. That's an important step to understand to get what this library is doing. And I'm doing that on a daily basis. So I'm not looking across all days and companies and ranking everything that way. If I do that, I'll conflate 2 things, which is the market's pricing maybe changing over time, as well as returns and momentum factor changing across stocks. All right, so here's the first plot that gets returned by this library. I'm going to take the time to walk through this, but when I left academia and I did basic research and studied computational neuroscience, and when I became a quant, this was the first plot that I really liked and understood a lot. So let me walk you through it. So here what we're looking at is mean forward returns. So the returns I would make 1, 5, or 10 days in the future. 1 is blue, 5 is green, 10 is red. So mean forward returns for stocks that are in one of these quantiles. Okay, so I'm averaging across days here, but every day I collect up who is in my worst bucket, my number 1 bucket, and what did their stock return over the next forward period. So what you're doing when you do an analysis like this is something you have to be really careful about in general in quant finance, which is you're looking ahead into the future, but you have to do that in order to say, does this variable I know about today tell me about the future? So you do have to be really careful about this in your analysis because it can be very easy to misalign your data. In fact, many projects I've worked on, you think you found something exciting, and finally when you figure it all out, you just misaligned your data, and you actually are trading on data you didn't have. All right, so what's cool here is that it looks like that based on a factor value, a quantile that I can know today, I know today if this stock is a 1, 2, 3, 4, 5, it tells me something about the returns in the future. So I can see this like monotonic increase in the returns in the future across these buckets. So that sounds pretty exciting, right? And you might be wondering, if I can predict the future, why am I even here talking to you today? Great question. So the y-axis is in units of basis points. A basis point is a commonly used unit in finance, and it's 1/100th of 1%. So this scale is pretty small. And also here I'm just showing you means. I'm not showing you anything about how noisy this data is, right? And I'm also not showing you anything about the real world and the friction that would be incurred, the costs that would be incurred trading this. So this is a kind of cool factor, and people use momentum a lot in the market, and it is very dangerous actually. But this plot alone is not sort of like so wildly optimistic. So then I told you that, right? I said, here we're looking at means. Means are really like almost worthless, I feel like, on their own for noisy data. So what if I want to know something about like the distribution of the data? So then we, as we're like building this library, we're like, I say, I always like looking at quantile plots. So we build some quantile plots. And then the data scientists that work with me are like telling me, this is crap because you don't know about what these distributions look like. So I allowed them to add this violin plot, which I then really, really like. So this looks a lot more conservative, right? Here we're kind of looking at how the center of mass of each of these, distributions of like what returns do I get, again, over 1, 5, and 10 days in the future based on information I know today, which is which category do you fall into. So here you can see like, okay, kind of, sort of, it looks like there's still some predictive power, but it's a lot more fuzzy picture. That's really one thing you want to get when you're doing research on data, I think, is like, at one time, both try to like pick up on trends that can allow you to think about things, but also not like reduce your data down so far that you miss the fact that it's super noisy and you may be picking up on just like little edge cases. I'm probably going to have to skip over some of these plots. I bet I have a million in here, but we'll see how much time I have. So now you can kind of think through, okay, I've got these quantiles, so I know that stocks in quantile 1 are probably going to lose money, and stocks in quantile 5 are probably going to make money. That's now my hypothesis. So what might I want to look at? I might want to look at the spread, right? So in one sense, if I can only go out and buy stocks in the stock market, which is what most of us can do based on regulation, then you kind of only care about stocks that you know are going to go up, and you're going to just like choose to not buy the stocks that are going to go down, right? That's kind of how you would trade, your own personal 401k, or, if God forbid you're out there just buying individual stocks willy-nilly, that's kind of what you could do. Well, in quant, we have access to shorting. So we can actually think of this ranking problem as like a bidirectional problem, and we can actually make money when we know stocks are going to go down, because given that I don't have time to necessarily talk about, but you can borrow stock you don't own, sell it, and then buy it back later at a lower price. So for the purposes of just thinking about this as data, you actually have a symmetrical problem, with the exception of like the costs aren't perfectly symmetrical, but nonetheless, we care about the spread. So if we can rank things and actually know what stocks are going to go down and up, we look at the difference between the returns that we would have gotten if we go short on the bucket that's going to go down and go long on the bucket that's going to go up. So this is plotting that. This is then saying, okay, and also, by the way, this is a time series, right? I told you I have a year of data. So then I'm showing you these means, but it's losing all the time information. And you're probably right in thinking, it's noisy over time, right? And if you lump everything together, it looks like you kind of have something predictive, but maybe it's noisy over time. So this shows that. It's very noisy over time. This is actually looking at just that 10 period forward return, which means like if I know the factor value today, what is it 10 days from now? So what you'd be looking at in a plot like this, I would be, if I'm trying to decide, like, is this factor something good to include in my stock selection model? I'm looking to see, is the mean or is the kind of low past 1 month moving average generally live above 0 or below 0, and how much it is. And the green line is, I think, just the mean returns. The orange is, the 1 month moving average, so 20 trading days, and then the standard deviation around it. So then the other thing, like an extension is you'd say, okay, so now I know that I can make money off the spread, but a good thing in the quant finance world to keep thinking about usually is, But is that factor like linearly or monotonically or overall, is it robust? Is it sorting correctly across all of these quantiles? And so here what I'm doing is saying, cool, I know there's a spread to be made, but what are the forward returns to each individual one of those quantiles? And this is just how I want it to look, kind of like a rainbow, where bucket number 1 is sort of the most punished bucket of stocks, and bucket number 5 is the most rewarded bucket. If it doesn't look like this, you'll sometimes have a factor and look at the returns to the quantiles, and you'll end up having said, oh yeah, there's a spread, but actually I could have made more money if I shorted the stocks in the 3rd quantile and longed the stocks in the 5th quantile. If across these quantiles things are not looking monotonic, then it kind of clues you in that your data is noisy in a different way than you're thinking about, and you might not have found the best factor to rank it. Questions on these so far? All right. I'm sure I'll leave time for questions at the end. So, all right, so now this is sort of back to a plot that's a little bit like that spread between my top and bottom quantile, but this is a little bit of a fancier version of that. So this is actually looking at, okay, sort of a proto-stock trading strategy. We're still not accounting for costs or anything, but we're saying, let's assume that we knew we want to buy the good stocks and sell the bad stocks, but now let's actually assume that we had information more than just what quantile they're in, but we actually now know their factor values again. So this is looking at returns to a portfolio where I long the good stocks and short the bad stocks, but in proportion to that factor value before it was quantized. So what I'm going to do is put more weight on the tails, basically. And okay, cool. It's kind of good to know if that looks promising, because that's a common way that people actually implement trading strategies. They say, let me actually assign weight to these bets that's based on sort of how good I think my information is. I actually like this a lot, so we also compute an information coefficient. This is another way of thinking about, is my sorting factor robust across a whole distribution of data? So you're just going to look at what is the rolling correlation between your predictive factor and the forward returns, right? Like if I sort this vector on the predicted factor and then I sort it on returns, what's the correlation? If it's 1, I perfectly knew the order of the stocks if I had sorted them on returns tomorrow, right? If it's, and you can see this scale again, these are like pretty small ICs, but a positive information coefficient in quant of like, just like a couple, like 0.123 is like very exciting to quant. So there's sort of like a scale question here. I talked about market sectors. So another interesting way to subdivide your data in this area is to say, well, does this factor have more or less predictive power for certain types of stocks? So here I'm looking across 11 stock market sectors, and I'm looking to see, does this factor have power across all of these? This one does, which is awesome. A lot of times what you'll see is your factor that you might be studying contains information about some sectors but not others. Financial companies like banks report their earnings and the information about themselves in a very different way from a lot of other companies. So they'll often look kind of weird when you look at them on their own, and this analysis lets you see that. All right, another thing we like to do in this library is, again, look at rolling plots, look at time series plots, but then always come back and say, okay, cool, but your eye is good at looking at certain types of data in certain different formulations, and we often like to go back and look at distributions and histograms. So here we're looking at the 1, 5, and 10-day forward information coefficients, and we're looking at them as a distribution. So, okay, that's pretty noisy, but now you're looking like, is the mean positive, and is it larger than the standard deviation? Not really in this case, right? So you can see how noisy it is. And here's a QQ plot of those information coefficients, so you'd like to be seeing more of like an S-curve if possible. So this heat map looks cooler when you have like many years of data, but I still like it a lot in my own work. So here we just have like 1 year of data. So we're seeing years is the y-axis and then months is the x-axis. And there we have a heat map that's just showing you what was the information coefficient in each month. We have heat maps like this that we use in our backtesting or performance library that's called Pifolio, where we're looking at the same kind of calendarized performance with returns. If you think about it, it's interesting, and I guess other time series domains are the same way. Like, this data changes over time, so it's also very interesting to understand if the relationships you think you're finding are persistent across time. And so we have heat maps like this, and then we have some like by year plots that let you get at that. All right, cool. So that factor, I showed you exactly what it is, right? It's very simple. It said what was the price of a stock last year and what was it today. And you might be thinking, well, real quants trading, hundreds of millions of dollars are probably doing something a little bit more complex than that. And certainly they are. They often build 400 factor multi-combinational models and try to do like really fancy stuff. I have one more example here, which is a proprietary alpha factor that we evaluated. It's sold today to institutional investors. I can't remember what the price tag is, but it's definitely 6 figures a year. And we evaluated it with our Alphalens library. So we were looking at this factor to decide, hey, should we pay money for this factor and license it effectively from the person who built it and put it into our investment strategy. So, we run our analysis. And so for that, right, we need to get the time series of returns, and we also need to get the factor values on any given day across our universe of stocks. So this looks awesome, right? We're like, yeah, totally, this is worth it. This looks pretty cool, looks better than price momentum. And then we said, all right, cool, let's look at those plots about, what would our spread be over time, or what's our kind of proto-trading strategy, and how does it look? And so, okay, it looks pretty good, right? It has this nice rainbow plot. Wow, like this looks really good. But, the analysis raises some questions. So what happened in late 2014? I'm curious if anyone would want to guess what happened to this data set in 2014. If I asked you to guess, what period of this time range do you think the person who developed the signal knew about when they developed the signal, and what period of time do you think happened after they developed the signal? Like, then you're probably starting to get a little bit of an idea, right? So it doesn't quite exactly align that this thing totally falls apart once it was built, but pretty close, right? So this is not good. Quants think this to themselves all the time. So my message kind of from that is even pros tend to overfit to historical data, and even when they're trying really hard not to overfit to historical data. So, public service announcement, be careful in any field that you're in to not overfit to the data set that you're looking at. We have a lectures page that talks about this and has these hosted Jupyter notebooks that walks you through a lot of this kind of work. So want to learn more or contribute, we actually have a bunch of different libraries. Oh yeah, so here I get to see all of these stars. I didn't even realize how important that was. So we have Zipline, which is our backtesting library. That was the first thing we open sourced, I think like 4 years ago or so. Then Alphalens and Pifolio were built by my research team, so those have been open sourced more recently, and then a couple of other libraries. But please come check them out, look at them, ask us questions, or work on them. And I definitely need to take a moment to say, other than I submitted basically requirements for these libraries, but these are the guys that wrote the libraries. James was an intern with us last summer, and he wrote basically this whole library during his summer internship. And so set like a really probably unfortunately high bar for every intern we ever have in the future. Thomas is a data scientist who works with me. Andrew Campbell, Jonathan Larkin's our CIO, who's my boss. And then the lecture content, if you go check that out, is put together by Max and Delaney. The entire analysis that I walked you through is part of a lecture that you can get to at this factor analysis level. So I don't know if I have time for questions, but if I do, 1 or 2 questions.
Stocks. My question was, you take quantiles, what kind of distribution? Is it over stocks or over times, over a range of like a year? Sorry, I'm very completely blank to this area.
Okay. Do we care more about modeling distributions across stocks or across time, like time series or cross-sectional sort of? Is that the question?
My question was about those you presented. You were talking about quantiles, so we didn't get which were those.
I'm talking about across stocks. So the quantiles, you could imagine the data would be very noisy if I just had one day, but it would look the same. So in a given day, we take let's say there's 500 stocks, and we take the factor value and we sort them into a quantile based on that, and then we look at, okay, so let's pretend there were 500 stocks and there's 5 quantiles. So I have 100 stocks in my first quantile, and that mean returns number, that's what would my returns be if I owned all those 100 stocks and I held it for 1 day or 5 days or 10 days. The way you can think about the time series dimension is I'm just adding up all the days. So if I have a big, sorted matrix of like for 1 day, the stocks sort into have factor values like 1, 1, 1, 1, 2, 2, 2, 2. Then I just have many days aligned with that, and so I just average across days. So that's why I was showing also some time series plots where you can say, oh, what if I just bucket the days together by like, on a rolling month basis? Like how consistent are those relationships across time? So you are in quant a lot of times flipping back and forth between the modes of thinking of cross-sectional, like it's easier, it's noisy data, so it's much better to think in terms of like relatively sorting all these stocks on a given day than making like an exact prediction, like Apple's gonna go up by X% tomorrow. So you think cross-sectionally in terms of quantiling and like how good are these factor values, but then you also wanna say like how those relationships change or are consistent over time.
Yeah, so I had a quick question. I feel like a lot of times when I see these time series plots with financial variables of some sort, you see some sort of oscillatory pattern that's there. And I think that I probably already know the answer to this question as it pertains to overfitting. But I always wonder if people take like a Fourier domain analysis or try to like, predict the of a particular vehicle.
Yeah, people do. I mean, it's so tricky when you see periodicity like that. There's lots of different, what's the time scale, whatever. So your eye always picks up on stuff like that. The examples where there for sure is behavior like that there are things that are seasonal. And so there's like seasonal, or actually here's a great example, a much smaller scale in time. If you look at the intraday trading volume of a stock, you will see a very predictable pattern, or all stocks. And it looks like a U, basically. There's a ton of trading volume in the morning. Nobody does anything at lunchtime, and there's a ton of trading volume right before the close. And there are a lot of different reasons that add up that are why it's like that. And I remember when I first saw that, I was like, wow, okay, so we know that. So that seems really valuable, like what the volume is gonna be. But it's very well understood. And so even when you have stuff that's seasonal or has sort of periodicity in it, that doesn't always translate into like an edge that you can have. But it is there. I mean, the thing I think is important to remember is like, while the stock market's not like physics in the sense that like, it's a human construction and like, so you can model it, then it can always change. Like a regulation can change and your model is like completely gone. But that doesn't mean that there's not structure in the data, right? There is structure in the data, and a lot of the things that people have found that are kind of persistent anomalies are when like there's just a structural thing in the data. Like take, for example, you have to put a bunch of stocks together and make an ETF, and you can buy the ETF or you can buy the underlying stocks. There's structural things about inefficiencies there that do exist. So you can find these relationships in the data. Where the rubber meets the road tends to be like, can you trade it? Like there's a lot of fine points there of like, is it worth it to trade it? All right, well, I'll be around for the rest of the day, so you have more time for questions? I'm happy to answer questions if we have time. Okay.
So great talk.
Where are you?
So you talked about sectors briefly, and you mentioned that they're often classified by companies and given out. So I wanted to know if there's any interest or work on algorithmic sector classification, because it seems like you could possibly discover like groupings of stocks that behave differently.
Yeah, we aren't doing anything like that. Sector classification is one of those like real world structural things about the stock market that's like so annoying, right? Because not only does a company decide what sectors, and they assign sectors and then industries and then like sub industries, and there's a whole like 5-dimensional layer to it. Not only do they do that in like a sort of arbitrary way, you have to pay them a ton of money to get that data every year. I know, it really drives me nuts. Don't even get me started on that. So yeah, I've done a couple things different times in my career where you can basically natively cluster the data, and people do try to do that. And then if you do that, turns out usually you often still pony up and buy the data that everybody else uses, because actually then if you have some difference of like you think these two stocks are more like each other than everybody else thinks based on their sector analysis, that could be profitable. So yeah, I absolutely. The thing is like, it's complicated too because, some companies are like these big multinational corporations, so just assigning them like a single, it's a financials company, it gets complicated. So I think it's also would be interesting to think about like, oh, what % contribution to, groups do you think? Some companies I think would sit at the nexus of like many different clusters, and some companies, that are smaller might be wholly within one cluster. So yeah, people look at that, and I think it's a really interesting area.
Hi. Do you have any plans to have your libraries available in R? And if not, why not?
I don't have any plans to. I don't have anything against R. Again, get disclaimer up front, I'm not a computer scientist, so I went to grad school at Berkeley, which is why I'm allowed to wear this awesome sweatshirt, and I did MATLAB, and just enough to be able to do my work, and then I did R at the first quant shop that I worked at. So R definitely has got a lot of really powerful statistical libraries. When I joined Quantopian, 4 years ago, Foss, our founder, had just decided like, hey, I'm going to pick Python and go with it, and I think it's more just like it's a good fit for right now in this space, and it allows us to focus and not be supporting, a bunch of different libraries. But there's no why other than we're so focused on like the stack of problems, the breadth of the stack of problems in front of us that we haven't really put the effort into it. But it's not like a reason that we think it's, not a proper, spot. I mean, if we could like have the bandwidth and just like somehow like totally add like R functionality and have access to this pool of people that only want to use R, like that would obviously be awesome for us. But we just haven't sort of prioritized that over the other stuff that we're working on. I know. Yeah, I know.
Hi, thank you for your talk. This may be a beginner question. When you're talking about 1, 5, and 10-day returns, are you looking at those from the perspective of 1, 5, and 10 days before the present day, or how are you determining those returns?
Those are future returns.
How do you determine what those future returns
right.
are then?
So I couldn't know that from today. I mean, I think I can a little bit, right? That's why I'm doing what I'm doing. You want to like our 51% edge. So what we're doing, remember, is we have, let's say, a year of data. So we're going back to the first day that we had of data. And so on that day, let's say January 1st, 2015, we know the factor values, and we already know the returns, right? We know they're like January 5th, January 10th, and whatever, the last day in January. So you can think of it like this rolling analysis that goes through time that's basically like shifting all the returns values 1, 5, and 10 days back in time to make them available to like align. Does that make sense?
So if it were true in the past, it would be true in the future.
Yes, so then you're getting at like really like the fundamental assumption that we are always trying to poke holes in when we're trying to decide if you should trade something. You're looking at a back test effectively, which has a lot of problems with it. It's like assumes that you knew all this stuff. In theory, you're trying to make sure you don't pretend you knew the returns. So you're looking for relationships in the data, and then you're implicitly making an assumption they will persist in the future. And that is like sometimes true and sometimes not true. Okay.
I was wondering if you've seen differences if you have a sort of very complex factor you're looking at with a limited data set or a simple factor with a very large data set, such as all stocks for all time, because there are only a few thousand publicly traded companies.
So the place that, so like I said, Quantopian, like people can do whatever they want on our platform, and then my research team is looking for strategies that have certain characteristics that will then work for our investment vehicle, and we're like a mid-frequency quant, stat RB-ish kind of thing, right? So for us, we're looking, there's no such thing, we don't think, well, we're trying to manage to very tight risk constraints. So a risk, right, like I mentioned, is your exposure to the stock market, but a risk is also how much of your portfolio is in any one stock. And that is a risk that we find undesirable for our investment vehicle. So if you don't want to be invested very much in any one stock, then you want to trade like every stock that's out there. So there are different ways to think about it. Some people approach trading and they think about like, I want to do event detection and I'm gonna make very few bets on very few stocks, and that can work. The thing is now it's very risky to like a thing that you didn't model. So think about like your probability of being wrong. And then like the way that we approach it is, well, your probability of being wrong, okay, how can you mitigate that is like making lots of little small bets. In the US stock market, there's like I think we have like 8,000 symbols in our database for like today. So we think about 3,000 of those are tradable to us, and really the top 1,500 most liquid are where we really want to be. And then we're looking at minutely returns data. So we have minutely returns data for, those stocks didn't always exist through time. So you got to make sure in your data set that you have no survivorship bias. If you just have only the stocks alive today and go back and get minutely data for them all the way back to 2002, like in 2002, you actually implicitly had the knowledge that that company was going to be alive until 2017. And you'd think like, oh, how often is that? Not true. All the time. So you need like the historical data set. So we've got effectively, 15 years of minutely data for, let's say, 3,000 stocks. That's kind of the data set that we have to play in terms of pricing. Then what you try to do is layer in like other data. So like corporate fundamentals data is available quarterly for all those stocks. Whatever, social media sentiment data, right, et cetera, et cetera. So the quant game is sort of played in that space of 1,500 liquid tradable US instruments. Now we just added futures, and then we're going to try to add international equities. So yes, like the idea is to continue to expand the cross-sectional area of instruments that you could find power in. And then the other way people go is like, try to get more and more granular time data, intraday data. Our platform runs about minutely, so that's sort of the time scale of the data that we're interested in. All right, well, thank you guys very much for your attention and your awesome questions. I appreciate it.